One of the biggest myths about investing is that you need thousands of dollars to get started. This misconception has prevented millions of people from beginning their wealth-building journey because they believe small amounts of money cannot make a meaningful difference. The truth is quite the opposite. Throughout history, many successful investors have proven that building wealth is less about how much money you start with, and more about consistency, discipline, patience, and allowing compound growth to work over time. In today's financial world, investing has become more accessible than ever. Fractional shares, low-cost index funds, investment apps, and automatic savings plans allow beginners to start investing with surprisingly small amounts of money. Even setting aside just $10 a day may not seem life-changing at first, but over many years, those daily contributions can grow into a significant financial asset when combined with smart investing and consistent habits. While there are no guarantees in investing, and every investment carries risk, the principles of disciplined saving and long-term investing have helped countless people build financial security. In this video, we will explore exactly how beginners can turn just $10 a day into a powerful wealth-building strategy, avoid common mistakes, and create habits that may benefit them for decades to come. Today, we will talk about how beginners can build wealth with just $10 a day. So, before we start, make sure to hit the like button and subscribe to my channel. The power of starting small. Many beginners delay investing because they believe small contributions are meaningless. However, successful investing is not about making one enormous investment. It is about building momentum through regular contributions over time. Saving and investing $10 every day equals approximately $300 each month, or about $30,650 each year. While those numbers may appear modest initially, they become much more powerful when invested consistently over many years. Small actions, performed consistently, often produce extraordinary long-term results. Why consistency matters more than amount. One of the greatest advantages available to beginner investors is consistency. Financial markets experience periods of growth, decline, and recovery, but investors who continue contributing regardless of market conditions often benefit from buying investments at a variety of prices. This disciplined approach removes much of the emotional decision-making that causes many investors to buy high and sell low. Consistency transforms investing into a long-term habit rather than an occasional financial decision. Understanding compound growth is one of the most important concepts every investor should understand. When your investments generate returns, those earnings begin producing additional returns of their own. Over time, this creates a snowball effect, in which your investment portfolio grows faster as the balance becomes larger. During the early years, progress may appear slow, but after many years of disciplined investing, compound growth can become one of the strongest drivers of long-term wealth. The earlier someone begins investing, the more time compounding has to work. Choose low-cost index funds for beginners. Low-cost index funds are often considered one of the simplest and most effective investment options. Instead of trying to identify individual winning stocks, index funds provide exposure to hundreds or even thousands of companies through a single investment. This diversification reduces the risk associated with relying on one company, while allowing investors to participate in the long-term growth of the overall market. Many experienced investors recommend index funds because they require very little maintenance and have historically performed well over long periods. Automate your investments. One of the easiest ways to stay consistent is by automating your investment process. Setting up automatic daily, weekly, or monthly transfers ensures that investing becomes a routine, rather than something that depends on motivation or memory. Automation also helps remove emotional decisions, because investments continue regardless of market headlines or temporary price fluctuations. Many investment platforms now make automatic investing simple and accessible for beginners. Avoid trying to time the market. Many new investors believe they should wait for the perfect time to invest. Unfortunately, consistently predicting market highs and lows is extremely difficult. even for professional investors. Waiting for perfect conditions often results in missing valuable investment opportunities. Instead of attempting to time the market, many successful investors focus on time in the market. Regular investing over many years has historically proven more reliable than attempting to predict short-term market movements. Build strong financial habits. Wealth is not created only through investing. Daily financial habits also play an enormous role. Spending less than you earn, avoiding unnecessary debt, maintaining an emergency fund, and consistently saving money create the financial stability necessary for successful investing. Even small improvements in budgeting can free up additional money for investment without dramatically affecting your lifestyle. Continue learning about investing. Financial education is one of the highest return investments anyone can make. Understanding stocks, bonds, exchange-traded funds, diversification, risk management, inflation, taxes, and portfolio allocation helps investors make more informed decisions. Reading books, listening to educational podcasts, following reputable financial experts, and continuously improving financial knowledge can significantly improve long-term investment success. Diversification reduces risk, although investing in one successful company may produce impressive returns. Concentrating all your money into a single investment also increases risk. Diversification spreads investments across multiple companies, industries, and asset classes. This approach helps reduce the impact if one investment performs poorly, while allowing the portfolio to benefit from growth in other areas. Diversification does not eliminate risk completely, but it is one of the most effective ways to manage uncertainty. Stay calm during market declines. Every investor eventually experiences market downturns. Stock markets naturally move through cycles of growth and decline. Temporary losses can be uncomfortable, especially for beginners, but history has shown that markets have repeatedly recovered over long periods. Investors who panic and sell during corrections often lock in losses, while those who remain patient may benefit when markets recover. Viewing market declines as part of the investing journey, rather than as permanent failures, can improve long-term outcomes. Increased contributions as income grows, starting with $10 a day, is an excellent beginning, but wealth building becomes even more powerful when investments increase alongside income. As salaries rise, side businesses grow, or additional income sources develop, gradually increasing daily investment amounts can significantly accelerate long-term financial progress. Even increasing contributions by a few dollars per day can produce meaningful differences after many years of compounding. Avoid high-interest debt. Building wealth becomes much more difficult when high-interest debt consumes a large portion of monthly income. Credit card balances and other expensive forms of borrowing often grow faster than investment returns. Reducing or eliminating high-interest debt may improve financial flexibility while freeing additional money for future investments. Managing debt responsibly is an essential component of long-term financial success. Think long-term instead of short-term. Many beginners become discouraged if they do not see rapid investment gains during their first year. However, successful investing is generally measured over decades, rather than weeks or months. Short-term market movements are often unpredictable, but long-term business growth, economic expansion, and compound returns have historically rewarded patient investors. Adopting a long-term perspective reduces emotional stress and encourages better financial decisions. If you liked this video and would like to see more like it, please give it a thumbs up, leave a comment, and click the button to subscribe.